Hey, everybody. Hopefully you had a wonderful weekend. We have a ton of information, so I'll go ahead and get started here. So, 5-minute moneymaker. This is an awesome thing for you guys to pay attention to. So, want to look and sound really different from all your competitors? Here are some excellent questions to ask at a first meeting. Do you have a fireproof safe? What should go in the safe? How do you know what is supposed to be in the safe and is actually in that safe? Where, guys, have you ever done that? Have you thought, oh, you know, my passports are in the safe, then you go look at your safe and the passports aren't there, or something similar to that? Has that happened to you? Where is the key or combination to the safe? Dudes, I got a lockbox that I have not opened for 5 years because I can't find the key, and I know that when I finally want to get into it, I'm going to have to just have a locksmith open that for me. How are you keeping your important family photos safe? That's an awesome question to ask. How many of your important documents are stored electronically? What do you mean electronically? So that's a great question to ask. Where do you keep your backup documents for those in the safe? What should be in a safety deposit box instead of a safe? What kind of shredder do you have? Where do you store the documents waiting to be shredded? Or do you shred them immediately? Guys, how many people go ahead and have a stack of documents sitting there waiting to be shredded, and then have workers in their house, have house cleaners in their house, etc. Those documents are sitting right there. In case of a fire, which document should you take with you? Trick question. None of them. Get out of the house now. And if you've done your financial housekeeping and address all these things up front, are you going to be worried about not taking any documents with you? So why would these be good questions to ask at a first meeting? Why would these be good questions to ask at a first meeting? Nothing to do about money, that's for sure, non-financial. And is it things people have thought about before? And could any of these be routed into major problems? I mean, probably the saddest thing after a hurricane or a house fire, what are people the saddest about? Photos lost, right. The photos that are lost, Raymond. So these are great questions to make you look different. The 5Q tape breakdown, do we have any clue as to whether they agree with us about the point he's making? Remember, you can never overdo catching, telling, selling, preaching, and teaching on your 15-minute drills and working on asking those open-ended questions. So one of the things I want to talk about today is pensions, and you'll see why here in about 5 minutes. So the unavoidable pension crisis. There is a really big crisis coming. Think about it this way. After 8 years and a 230% stock market in advance. So has the market seen the wind at their sails like this for a very long time? And even so, after that, Dallas, Chicago, and Houston are in severe trouble. Their pensions are. And so, but it's not just the municipalities. The public and private pensions still operate in this country are all in trouble. Currently, many pension funds like the one in Houston are scrambling to slightly lower their return rates or issue debt or raise taxes or increase contribution limits to fill some of the gaping holes of the underfunded liabilities in their plans. The hope is such measures combined with ongoing bull market and increased participation contributions will heal the plans in the future. This is not likely the case. So I know a teacher in Chicago. You want to guess? Do you want to guess what this teacher in Chicago is, what his pension plan is? He's a driver's ed teacher, and guess what his pension plan is? How much per year? Not even close, Dave. Getting closer. $120,000 a year that he'll get at age 57. Yeah. What? So what do you think's going to, if I was that guy, do you think I'm going to be confident that I'm going to actually be getting that 120 a year? How long before, well, first of all, he's in one of the cities that's what? Duh, no wonder its pension fund is getting hammered. And I love teachers. I think they should be paid way more than they're paid. However, I think they should be paid while they're teaching. They shouldn't be paid $120,000 after they're retired. Nobody should be getting that. That's crazy for a pension. So the reason I bring this up is there's a lot of things going on now with pensions that we can actually help people with. In April 2016, Moody's analysis pegged the total 75-year unfunded liability for all state and local pension plans at $3.5 trillion. the American Enterprise Institute that says 5.2 trillion. I don't care if it's 3.5 or 5.2. That's what? That's trouble. Pension computations are performed by actuaries using assumptions regarding current and future demographics, life expectancy, investment returns, levels of contribution taxation, payouts to beneficiaries, among other variables. The biggest problem following two major bear markets and two subpar annualized returns since the turn of the century is the expected investment return. Using faulty assumptions is the linchpin to the inability to meet future obligations. So what happened? Why are these pensions unfunded? What did they do? They overestimated returns and has artificially inflated future pension values and reduced the required contribution amounts by individuals and governments paying into the pension system. So this is our average since 1965. This is the market. So an average of a 7% rate of return. So this is where we are, and then this is projected. They're just keeping it near the 7%. And if anybody thinks there's going to be a bigger rate of return over the next half here than there was over this half, you're sorely mistaken, which I'll talk about here in a second. So you can see that this gap is what? There's the gap. This is the promise. This is where they're at. How big a gap is that? So what are they going to do? They got two options. For municipalities, what are the two things they can do for this? What are the two things they can do for municipalities and government? Yeah, raise taxes is one, or what? Lower what? The pension. So, are there more people or more government employees? Are there more people or more government employees? Okay, so what do you think more likely to happen? That they're going to be able to pass through a tax increase to pay for the pension, or the pension is going to get decreased? That pension is going to get decreased. I would not be counting on my pension right now if I was a government employee, either state, federal, or municipal. So state retirement systems combined, unfunded liability, you can see what's happening to that. Even after the best stock market return we've seen in 3 decades, what's happened to the unfunded liability? It continues to what? Go up and up and up. Of course, how about corporate pension plans? What's happened to it? In 1995, they were 11% overfunded. Look at what's happened. Oops. So yeah, in the roaring 90s, they were overfunded, and then what happened? Boom, 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 boom. But guess what's not happening? They got so far unfunded, and here's the other thing you have to think about. Pension plans are because companies are putting in money per employee. What's happening to the vast majority of corporations? They're hiring more people or they're shrinking? Getting smaller because of robotics, because of efficiencies, because of computers, because of whatever. They're getting leaner and meaner, which means what's happening to the amount of people pouring money into the pension plan as compared to the amount of people that are currently living longer and not dying. So what's going to happen to this unfunding? It's going to go down or go up. I don't care what's happening with the rates of return, which we're going to talk about in a second, but it's going to get bigger. It's going to get bigger and bigger. So how safe is your pension? Private sector and public employee plans are significantly underfunded. This is Consumer Reports. If you're counting on a traditional defined benefit pension, there's a reason to worry that you might not get everything you've earned. About 80% of the 29,000 private sector defined benefit plans insured by the federal pension, because is PBIC going to get you out of this, guys? Is the Pension Benefit Guaranty Corporation going to get you out of this? They're underfunded by $740 billion. So are they going to get you out of it? No, not even close. Instead of beefing up plan assets, many companies have cut benefits. Wait, you mean they can cut my benefit? You mean that pension they promised me, they can actually cut that? Employers can change their pension rules going forward using a variety of tactics, including tinkering with the benefit formulas so that your eventual payout will be reduced, freezing the plan to stop further accruals, or terminating an underfunded plan. Vested pension assets, those that are legally become your property after a period of time, are generally safe thanks to federal law. But if the plan is terminated, PBI, the Pension Benefit Guaranty Corporation, which itself is $26 billion in the red, is required to pay vested benefits only up to a certain amount. So even the vested benefits, are there two loopholes that they can get out of paying you, even if you're with your vested benefits? Are there two loopholes right here? They could terminate the plan, and also the guarantee is only to a certain amount. Now, ARP was talking about, can they grab your pension? Ed Cochran weathered hands began to tremble as he read the letter from his union pension plan. We made a terrible mistake, it began. The June 2013 letter said he was overpaid for nearly 2 decades to the tune of $97,000, including interest. He demanded that he repay $66,000 within 3 weeks or face steep cuts to future payments until the overage is recouped. Now, that's not as important as this. What's also fading for retirees who still enjoy a pension is the promise of a guaranteed income for as long as they live. Legislation passed in December 2015 overturned 40 years of labor law allows certain troubled multi-employer plans to cut promised benefits to those under age 80. So, if you have an employee with a pension that thinks that that they're sitting on they've got the cat's meow or whatever, sitting on the cat house, they should rethink that. And if they have the opportunity to cash out of that pension, you should call Jerry, because Jerry has a great illustration on why, if you have a client who has to make a decision whether to keep the pension or cash the pension in, Jerry's got a great way to demonstrate why it makes sense to keep your pension or why it may make sense to cash it in. So if you're in a situation where a client's saying, I've got this pension, they're asking me whether I should want a pension or cash it in or not, please call Jerry. Make sense? So we don't run into pensions as much as we do, but when we do, we need to make sure we're addressing them, because people think, if you think that, people do think that it's written in stone, and they don't understand that that pension can go away. And over the next 2 or 3 decades, guess what? Those are going to go away, even if you have them right now, based on that. Make sense? So we're in the flood season, right? So what does it mean with a 100-year flood? This is from the Risk Analysis International Journal. Examining a 100-year floodplain is a metric of risk of loss and household adjustment. There's no surprise to experts who say the concept of the 100-year flood is one of the most misunderstood terms in disaster preparedness. In the wake of catastrophic flooding in Texas coast, the media has been working hard to explain the term, turning out dozens of articles explaining the 100-year flood is not a flood that you should expect to happen only once every 100 years. Instead, it refers to a flood that has a 1% chance of happening in any given year. Over the course of a 30-year mortgage, a house in a 100-year flood plan has a 26% chance of being inundated at least once. So guys, is that confusing? Confusing to me. Statistics are confusing as hell. Because you know what? Guess what I think, and guess what clients think when you hear a 100-year flood? Guess what I assume? It's going to happen what? Every 100 years. It ends up, no. It ends up, I got a 26% chance of having a 100-year flood hit me if I have hit my house in the time that I own a 30-year mortgage. That's crazy. That's not anywhere near what I would have guessed the what the likelihood would be. Okay, so here's the probability. Even in 10 years, you got a 10% chance. In the next 10 years, you got a 10% chance of getting hit with a 100-year flood. In 20 years, you got a 20% chance of it getting hit with a 100-year flood. So here's the thing, though. Houston has seen 3 100-year floods this year. This was last year. Houston has seen 3 100-year floods this year alone, and 3 500-year floods in the past 3 years. So what does a 100-year flood and 500-year flood mean to somebody owning a house? Nothing, right, Tom? Absolutely nothing. It means, should I be saying, oh, I can go ahead and build on the banks of this river because they had a 500-year flood last year? No. What should I assume? How should I build my house? What should I assume when I'm building my house? Yeah, build it on stilts, Wade. Build it on stilts. I should assume I'm going to be flooded. Now, if I'm not flooded, am I still okay? Yes. But I should be assumed that I'm going to be flooded. Now, the reason I bring that up is when you look at market returns, they say there's only a 10%, there's a 10% falls in the market happen about once a year. 15% falls in the market, happen about every 24 months. 20% every 4 years. 30% every decade. 40% every few decades. Well, we already know that this is BS, right? 50% is 2 to 3 times per century. We already know that these numbers are BS. Why? What's happened in the last 20 years? Yeah. So this means nothing. And here's the thing. Look at it. This is the chart from 1906 to 1924. The market had a cumulative. This is not on average. This is cumulative through the whole, whatever that is, almost 18 years. It lost 4% from the 1906 through 1924. It lost. It didn't gain any money. It lost. So that means if you had $100 in 1906, you would have had $96 or $93 in some sense in 1924. 18 years. What if you'd retired in 1906? Good retirement, bad retirement. Now, if you retired in 1924 to 1929, you saw the markets go up 300%. But then from 1929 to 1954, the cumulative return was 1.69, which means if I start out with $100, I end up with $101 in 1954. So if I retired in 1929, how is my retirement? Of course, if I retired in 1954, for the next 12 years, I saw 154%, so about a 10% rate of return per year. But then from 1966 to 82, if I started out with 100, I would have ended up with $100.83. So what is that? 72 or 76, 82? What? 18 years? 18 years. Of course, if I retired in 1982 to 2001, I would have saw what? 856. From 2000 to 2009, I would have saw a negative 25. I started out with $100 in 2001. I would have ended up with $75 in 2009. Of course, right? This is only the 14, so we would see another 240% increase. So why do we all think that the stocks are going to get our clients out of into a great rate of return for the rest of their lives? The retired clients get great rate of return because we lived through what most of us were doing what during these years. So we've seen boom to boom. We've seen huge chunks of great rates of return. But if we go look this way, is there more green or more blue up to 1982? More green or more blue? And green is good in this case or not so good in this case? Now, from 1982 to current, we see a lot more blue, a lot more blue, or a lot more green. So you know what? It's return to mean. So guess what we're looking at going forward? And the reason this is important is because if you're 20 years old, I don't really care. Put all your money in the market. But if you're retired and you have to pull money out during these green times, guess what? You're screwed. So we need to be worried about sequence of returns. And people have to understand that when you lose 50% in the market, you have to double to get back around even. When you lose 40%, you have to go up 67%. You lose 3%, you have to go up 43%. Now, the reason this is important is that we work with people who are retired. So should you be pulling money out? Should you be pulling money out of your accounts during these green periods? Because if you are, what's going to happen to your account? What's going to happen to an account? It's going to dry up. Yes, it's going to dry up. Now, the importance of that is that if we tell our clients they're age 63 or age 64, and we tell our clients, hey, don't pull out any money until the market comes back, dudes, what is happening to people that's age 64 to age 74? What's happening to them? Getting healthier? Getting less healthy? Getting more able to go on trips to Europe or trips to New Zealand, or less likely or less healthy to do that? More likely to be able to take the whole family and want to be active, or less likely? So when you start telling them that they can't do the things they want when they're able to do them physically, are you being a good financial advisor or a bad financial advisor? That's a bad financial advisor. You don't ever want to be in a situation where you tell your clients, hey, we can't pull money out of our accounts. Or even worse, don't tell them that and then have them wipe the account out over the next 10 years. That's even worse, right? So when you're 20 years old and you're accumulating the money, this is showing 50 years. with a 70% stock, 30% bonds, simulated returns using Monte Carlo. Well, when you don't spend any money, guess where all of these graphs end up? Does it matter how, if they average, if they all of these averaging the same rate of return? Yes. So they all end up what? They all got there differently, but they all ended up right here. Now, does that change when you start pulling money out? Significantly. That's what it looks when you pull out 4%. You got several of them down here that ran out of money. The rest were significant. About half of what, or many more, were below half. Some of them were able to stay about as much as they had. Some you still made a lot of money. So it all depended on where you're at. But do your clients want to gamble on being here versus down here? If you do you think that they want to gamble on that? No. So the chart below shows two 30-year income scenarios. The solid lines shows a withdrawal plan that started off with 3 years of negative returns in a row. The dotted line represents a withdrawal plan with negative returns at the end. So they were identical returns, except one started with the best 3 years at the front, and one ended up with 3 years, bad 3 years at the back. Well, if you start out with those bad 3 years at the front, what do you got? Got problems. So both plans started with a $250,000. Both took out $12,500 per year, inflated for 3% inflation. No other actions were taken to manage income withdrawals. Both plans had a 6.6 average. They both averaged 6.6 average rate of return. And look at what happened. Running out of money at age 80 versus being, doing great at age 91. So do we know where our clients are which of these lines our clients are going to be in? No, we don't. So the way I like to show it to people is this, and we have slides for this. And people do not get this. People do not get a sequence of returns. So this really gets them. If I have $100,000 and the average rate of return is 6%, and I pull out 6%, what will I end up with at the end of 10 years? If I'm making 6, pulling out 6, what will I end up at the end of 10 years? Same old, right? Except that it depends. Because this is an average 6% rate of return here. But what I did is I had minus 35, minus 25% loss, and plus 25, plus 35 at the end, and 10 in between. But if you add all these numbers up, because these cancel each other out, right? And then 1, 2, 3, 4, 5, 6. There's your average 6% rate of return for the 10 years. Guess what I would have ended up with? $22,000. So if things don't work out in my favor, how badly will I get hurt? It's still a 6% rate of return. I'm only pulling out 6%. I should end up with $100,000, but I get to be hurt. Now, what if I flip these there? How much benefit will I get if I'm smart and I know for sure we're not going to have these negatives at the beginning, we're going to have them at the end? How much of a benefit do you think I'm going to get if we flip these plus 35, plus 25, and negative 35 and negative 25? How much benefit do you think I'm going to get? A lot or not? A lot of people are saying a lot, some are saying a not. 101. So how big a difference is that between 100,000 and 101,000? Virtually no. What do you mean? How can you say astronomical, Raymond? I'm confused. The difference is $1,000 is an astronomical return? Guys, do you get that? Let's go back here. 6% rate of return, what do you end up with at the end of 10 years? Oh, I see what Raymond's saying compared to the other. Compared to the other, you're absolutely right, Raymond. It is astronomical. But if these returns don't work out in our favor, we're going to end up with with a $22,000. That's an 80% decrease. And you're right, Raymond. If that compared to the 101,000 is astronomical, you're absolutely right. But how's the 101,000 compared to the 100,000? So are we really getting a big wind in our sails if we call it right? Are we getting the wind in our sails if we call it right, where we predict it? No, we're not going to have a big downturn in the next couple of years, so we can go ahead and be wild and crazy with the stocks. Are we getting a big No, we're getting what? $1,000 increase. Wow, 1% increase. Wow, over 10 years, a 1% increase over 10 years. No, that's crazy. Especially when you compare it to, I could be wrong and have them down their accounts down 80% in 10 years. So when it comes to sequence of returns, we need to know what we're doing. Now, this is from Wade Foe. Many of you know who Wade Foe is. He's probably one of the most, and his buddies here, but he's one of the most respected researchers out there right now. So he's saying, if returns fall, you must withdraw less. According to forecasts by Foe and his co-authors, you can't really rely on income guidelines that have worked in the past. Chances your money will run out in 30 years based on initial withdrawal rates. So the blue is their forecast. The black is historical. This is the chance of running out of money. So they're saying with the 5% withdrawal rate, which none of us would ever do. So let's go to the 4% withdrawal rate. Historically, you'd have no chance of running out of money. But they're saying what if you use a 4%? Historically, you'd have a 0% chance of running out of money with 4%. But they're saying 50%, 7% chance of running out of money. Why? We're going to talk about that here in a second. This is with a 50 stock, 50 bond portfolio. 3% withdrawal rate, 0% chance of running out of money historically, but you still have a 24% chance of running out of money. Guys, how many of your clients have you said, we got a 24% chance of running out of money, would be happy with that? I want everybody to answer this. Yeah, everybody's saying none. So that's even at a 3% withdrawal rate. So why do you think that they're saying the forecast is different than the historical? What do you think that the reason they think going forward our returns are going to be much less with a 50-50 portfolio than they are right now? Why do you think they say that? Wade, you got half of it, and Dave, you got half of it. So everybody's getting half. That's good. That's awesome. So one point is, right now, bonds are going to do what over the next 10, 20 years? Are we going to see the kind of returns that we saw here and here? No, we're not. Now, there's another thing here. This is the CAPE ratio, price earnings ratio, and where is that right now? So we got interest rates way down here, and we got PEs what? Way up here. So how much room with PEs at 32, how much room does that give for stocks unless we have unbridled growth? And again, what's happening to our populations? Are we growing, or is it, I mean, what's happening to the efficiency of companies? What's going to happen to the profitability of companies? Are we going to go past 32 PE? Yeah, they're going to be stagnant. Can it really go past what are going to go to? Do you think that we're going to see a growth of 30%? I mean, what do you think our GDP is going to be? What do you think our growth is going to be? Remember, we talked about last week. Where's our debt right now? How much consumer credit card debt do people have right now? A lot or little? Yeah, higher than it was in 2008. How much? What's happening to mortgage debt? Same thing. What's happened to derivatives so corporate debt or derivatives where they're taking loans on, banks are taking loans on things? Way up. If that's the case, where are these people? What's happening to wages? Flat. Are wages keeping ahead of for 90% of the population? Are wages keeping ahead of inflation? No. So everybody's up to debt, up to their neck. Their wages aren't going up. Please tell me how the frickin' magical thing's going to happen that corporations are going to start seeing unbelievable profits when people don't have any more money to spend than they have right now. Please, somebody educate me. Well, one way they could do it is replace all of their workers with robots and become very efficient. Well, then what's going to happen to people buying stuff? They ain't freaking lowering taxes. That's not going to help them. Guys, do companies make money by paying less taxes? How do companies make friggin' money? By selling stuff. That's right. How are they going to sell stuff? How are they going to sell stuff when wages aren't going up and people have already leveraged themselves to the hilt? Please, somebody tell me how that's going to happen. So are we going to continue to see the companies maintain this? And remember, I looked at last week when we on our coaching call, what were the predictions of the growth for in 2007? What were the predictions for growth in 2008? High or low? It was high, and then what ended up happening? It was a third of what they predicted. It was crashed. So, guys, do you get why that Wade Pho and his buddies are saying the likelihood that we see the rates of return over the next few decades? And are Wade Pho and his buddies the only people saying this? That we're going to be looking at very slow growth in the U.S. So that's why he's saying, listen, just because historically it worked, I wouldn't be counting that on the future, because historically is not indicative of what's going to happen over the next 10 or 20 years. So what's our solution for that, guys? What's our solution for that? How do we protect our clients? What's going to give our clients the highest rate of return? Yeah, I agree with you, Frank. Frank's saying the CAPE at 31.74 is in the lower end of the mania range. I totally agree with that. Yep. So what did Ibbotson find? That a 60-40 stocks and FIA would give you the highest rate of return. Okay. Not only does it give you the highest rate of return, but what will not happen to at least 40% of the portfolio? No loss. When the client is seeing no loss on a big chunk of their portfolio, does that give them the intestinal fortitude or bravery to stick it out with stocks? Yeah, that's right, Mark. At least no panic, at least less panic. And heck, if you reverse this, if it's 60-40, 60% FIAs, 40% stocks, they're going to even have more bravery. Also, what have we found? Those of you that have looked at the American equity charts for FIAs and all the other charts for FIAs versus the market since 2000 and 1998, it was really since 1998, what has beaten the market? The FIA wins. Why? Because when you don't lose money, it doesn't take that much of a return to do well. So if we want our clients, and we should be worried about our clients' the risk of a sequence of returns, what should we be doing for our clients? The very thing that we recommend for our clients to do. But I take that back. Are we recommending that our clients do 50-50, 60-40, 40-60? Nick's got it right. Till's got it right. That's right, Nick. They're recommending. They're deciding. But should we, now that we know this, should we be there? Are there some advisors out there that think, like Fisher Investments, that think their clients should be 97% in the stock market? And are they idiots? So would they sign a document saying that if their clients got into trouble, they would give up their house? No way. But what we're doing, guys, we have the full confidence that what we're doing is the right thing. What we're doing is the right thing. So 2 lessons today. If you have somebody who has to decide about a pension, whether they should take it or lump sum it, or take the pension or lump sum it, make sure you call who? Jerry. And knowing what we know about the likelihood of high rates of return going forward, are we doing the right thing or not doing the right thing by walking the client through and having them decide that they want 50-50, 60-40 FIAs versus the stocks? Doing everything the right thing. So you guys are the people with the white hats. You are the knights in shining armor. I hope you understand that. And the more people you see, the more people are going to know that you are the real deal. You are the thing that every other advisor out there should be doing. So thanks for being part of 5Q. Thanks for doing all the hard work, and keep doing what you're doing, because you're going to be the savior of a lot of people going forward. You're the Lone Rangers, exactly. So you guys have a great rest of the week, and we'll talk to you all on Monday.